Thank you so much for being a part of AfroEconomics Live this Wednesday and every Wednesday, God allowing. I will be right here doing some discussion of some timely financial topic. And when it comes to money, I say everything is timely, right? But money is vital. And he said, don't, what is that saying? They say, like, make money, don't let money make you. Well, the best way to avoid money dominating your thoughts is to understand how to maximize the dollars that you work hard for every day. We're putting in maximum effort, but we don't put in maximum time trying to make sure that we're doing the right thing with our money. So thank you for taking the time to empower you, because what you do today determines the lifestyle of someone else tomorrow. Indeed. So let's look at work retirement accounts. And also, like, what's up in your 401k? What's up in your 2S TSP? What's up in your 457? What's up in whatever you're doing through work, even if you're self-employed? What's up with the retirement plan? When's the last time that you checked out your investments, right? One of the tips that I want to make sure that I take home is that, I'm always telling you, set it up automatically. Automatically is cool. But I'm going to tell you, my 8th tip today is don't be lazy. Don't be lazy just because it's automatic. We need to still look at it. And it's so much that we think we know and we don't know. So get the details, get the information, get the performance, get the historical performance. And look, don't let the ease of these e-statements fool you, because they will go, your e-statement is available, and you don't look at it. And that's why I love it, but I love the fact that in our AfroEconomics membership, we get together every quarter, and every quarter I want to see your most recent financial statement. And you would not believe how many times I get, by the time we get to the meeting or get to the call or however we're connecting, they go, oh, I don't know where that is. We really need to say that just because they have this, because that will actually don't allow technology, which is supposed to be set up for ease of access, to separate you. I was talking to a client that left his job about 6 months ago, and he still doesn't know his passcode to the retirement account where he left a lot of money. So we have to, I said, so let's do this. By the end of the year, let's say you know everything, your passcodes, we've looked at your statements, we've done your risk analysis, that we've compared what you have in there, how you need to maximize it, or if you want to consider rolling it over into an individual retirement account. But first, before you do anything, you need to know exactly what you got, right? You have to have a full understanding of where you are right now. It's like when you go to the store and you go out to the store and you buy some more shoes. You just buy some more. I mean, I have done this myself. Like, I've ordered black boots. And what makes me mad is when you realize that you have some black boots that look almost just like the new black boots that you got, and that you didn't like the last ones that were just like that same style. So but if you do an inventory, or if you have everything organized, then before you're acquiring anything else, you just make sure that you know first what you got. And that's how you have to look at your investments. I mean, people buy repeatedly the same investment, all these different places. They got it at work. They got it in their account with somebody else. They got an account over there. All of these different named funds, same fund, same goal, just a different name on it with a different company, same whole bunch of the same stocks in the same fund, and they don't even know because they haven't taken the time to see what they got. And you can have the same fund with the different fees, which is another thing that we're going to talk about. Like, you can have the same fund but sold a different way, and they could have actually added a whole bunch of expenses, which unfortunately is happening a lot in our community, where there's companies that are focusing on our community to sell the same fund that is available without those additional expenses on when they take it from a no load all the way over to a full service fund sold by somebody who's walking around the neighborhood trying to recruit you. So we have to be careful and look at the core of the investments that you have. So first things first. One, work retirement accounts offer big tax breaks. Now, if I told you, a lot of people would get mad at me, but if I told you the truth, that your retirement account can actually give you a better tax savings than owning your home, many of you might say that I'm a liar. I say, oh, that's not true. Why would she tell us we shouldn't do that? Why should she tell us? I didn't say all that. I just said for most Americans, especially those who just take the standardized deduction, they will do better by maximizing their retirement plan at work. It will reduce their taxable income. Most people are buying these homes and they're not even getting the tax benefit of that interest that they're paying on that mortgage that they got into because they said, well, at least now I get to write off the interest. No, you're taking the standard deduction. Now I'm telling you, the majority of Americans are taking the standard deduction. That being said, that means they would have gotten the same deduction with or without having that interest that they're paying on that mortgage. But if they reduce their taxable income by participating in their work plan, they will actually be able to, they're saving more for their future, and they actually be able to reduce their tax bill. Amazing, not told to us enough, but I'm telling you, those pre-tax work plans are the bomb diggity, and we're not taking advantage of them. My third is employer matches. Check them out. But the second point, okay, your first is retirement accounts have big tax benefits. A second, that there are major forms of these plans. All are, the two major ways are just pre-tax and Roth. There's only two major forms of work retirement plans, pre-tax and Roth. And the Roth you have to look into because it has some limitations. And the Roth is for your after tax. So you don't get that tax deduction in your current income, but the Roth will allow you to draw it out at retirement age without having to pay taxes at that time because you paid taxes on it during your work years, on your contributions. And another point is that we'll talk about extensively. Those of you who hang in, we'll talk about more, is that Roths are very flexible. So it's the first, retirement accounts give you a big tax benefit. Two, there's two major forms, the pre-tax contribution plans, no matter what they call it. If it's a pre-tax plan offered through work, taking your payroll and taking your money and putting it directly before you even see it, that's a pre-tax benefit as long as you choose for pre-tax contributions. I've met people who have been doing it with after-tax money for years and years and years and didn't know, and it wasn't in a Roth or it was just in an after-tax. But a lot of plans now have the Roth as an option and the pre-tax benefit. Most of you who are going to need that current pre-tax benefit. So I suggest a lot of times is max out your pre-tax benefit first. Then when you need to save even more, let's check out that Roth, right? So, but max out those pre-tax benefits first. And then the employer matches. What a nice component. If you work somewhere and they will match your contributions, make sure that you take advantage of that. But just because they only match 3% or match 4%, that doesn't mean that that's your max. So I'll say, hey, Don, are you participating? Are you maxing out? And say he says, yeah. And I go, oh, because I got to do a part two because I know I've been doing this business so long. Like some people will really accept like, oh, yeah, you're maxing out. Okay. Good for you. Let's look at this. No. Okay. Well, what percentage are you putting in? And they go, oh, 4%, because that's what the company matches. That's not maxing out. That's just getting at least the 4% match on the first 4%. That's what they said. But you're maxing out in your company based on your income. It could be 10%, 15%, 20%, whatever the maximum amount they allow you to put in, that's maxing out. I told my young co-worker to do this. Can't give away free money. No way. And you gotta, but everything in life takes discipline. Right on. Yes, indeed. And we have to lead by example, right? So if you tell a young coworker, oh, you should do that, it's even better when you say, I have been doing this, girl, and this works. You know what I'm saying? That's what you want to say. Lead by example, because they learn more by what we do than by what we say. If I say, oh, you should use your money carefully, and all you see is JB Bryan wasting money, then what is that? What is that? And we have too much of that, really. We have too much of that. So that, especially people in my position, like suggesting things and giving you ideas and telling you what to do, and then not truly believing it. And I remember like 10 years ago when I used to carry a heavy debt load, and I said, I want to walk like I talk. I want to make sure if I don't do anything else that I always focus on keeping my debts low. Because a lot of times we can get caught up in, especially as entrepreneurs, business owners, people at workplaces, and you want to look successful. But I've noticed that most of our success is what people cannot see. It's what's inside. These things that are on, I say, right? Your balance sheet. Nobody walks around with their balance sheet showing their assets and their liabilities in there. We would look at people totally different if they had to walk around with negative 200,000 net worth because, they owe so much on all their debts. Negative 300,000 because of huge school loans, negative, we totally, so God have mercy on us, right? But what we should do is acknowledge that ourselves, that no matter what the bank is willing to do or give you, that you don't have to take advantage of it. We have to be very careful, and that the young people and older people and everybody needs to realize that it ain't fun saving all your money, you know what I'm saying? But it ain't fun being grown and broke either. So think about it. Another comment. That's right. That's indeed. So, girl, it's been a minute. Had to see this one. Oh, that's so good. Oh, yes, indeed. Oh, okay. Thank you. And somebody else said hi to mama. And somebody else said, how you doing, Ms. Crawl? So thank you so much. So employer matches, make sure that we fully participate. And then a fourth point is realizing the early withdrawal penalties can kick your butt. Now, I would say women are really, really guilty of this. They switch jobs and they don't take their retirement seriously. No, and then on average, people are changing jobs about 7 times during their career now. Like, especially my millennials that are watching, you change jobs a lot more regularly. So you have to be very careful that you stay in control of your retirement. Like sometimes I, suggest if you have a full understanding and have a good financial advisor, you develop a good IRA with good investments, minimal fees, and that you start putting your IRAs when you change jobs, you're rolling your work plans into your IRA. And by the time you get to the end of your career, you have this big retirement account. But if every time you switch jobs, you get rid of you take an early withdrawal and a tax penalty because you're still not 59 and a half, and you're taking a hit every time you change jobs, it will hurt you as you get older and you realize, wow, I've switched jobs a lot and I spent my money every time. Big mistake. Make sure you take your savings seriously. Indeed. So be conscious of early withdrawal penalties and realize that there are ways to avoid them by staying in that work plan, rolling it into the new work plan, or rolling it into your own individual retirement account that you set up with your financial advisor, or some other firm. There's so much things going on, but whatever you do, make sure you realize what tax consequences and what's going on. Of course, I always suggest talking to your financial advisor, preferably me, right? So avoid loans. Avoid loans. We take them out all the time. People take them out and spending my own money. But if you're saving $200 a month, you take out a loan, the loan payment is $100 a month. So now you've cut your savings in half. Unless you increase your savings to $300 a month, you're getting behind because you're saving less, because half of what you're putting in is going to that loan payment. You got me? So the loan is not cool. And if you have to quit that job or you have to change jobs, God forbid, there you are jacked up with this loan that can become taxable income immediately and have those tax penalties if you don't pay for it during a job change. Or some places will allow you to continue to make the payment if you retire or if you leave it. But a lot of them will, if you're not at retirement age or whatever, they're like, it's got to be paid before when your payroll stops, or it's going to become taxable income within 90 days or 6 months or whatever their plan is. So be very careful with loans and make sure you know exactly what you've got to do, because there's so many things that you see as, I've got to do this. And sometimes you don't have to do this. So think it through. Think it through. I encourage you. That's why I feel that having the membership can really help keep wealth in our communities when we have someone on standby as a financial advisor that you can get to. It's amazing how prepaid legal has become so popular, and people pay a fee to get access to attorneys, but I don't think they actually have an exact attorney that is theirs. Like, they're not really paying directly to this person. They're just paying for access to. But with AfroEconomics, you have direct access as of this day to me. Now, I'm not even gonna say probably, there will come a time where you will have different people appointed to people. But everybody that's signing up now, you are with me. So I think that this is a great opportunity for you to get exactly what you deserve from a service perspective, and having a team of support for you as an advocate and as a financial advisor. So a sixth point is that the Roth is so flexible. The Roth is extremely flexible, but it also has like the maximum income that you can have to participate and things like that. So it has its disadvantages, but your Roth is flexible even out of a work retirement plan. The Roth you can have access to your contributions without penalty at any time. So it's almost like it can be a tax deferred emergency account, but it's a retirement account. But it does have a lot more flexibility. We could have a whole workshop on that, but it is indeed a retirement plan. And the Roth is a type of account. It's not an investment. So we have to be very careful with that, because people say, I want to invest in an IRA or I want to invest in a Roth. Like, the IRA and the Roth are what your investment is placed in, but it is how your account and your money is taxed, but they're not an investment. An investment goes in those accounts. So you set up an account. We can set up an account as a joint account, an individual account, an individual retirement account, a Roth individual retirement account. It can be, those are just the types of accounts. You have business accounts. There's accounts. What you put in those accounts are up to your risk tolerance, your goals, and in many cases, the financial advisor that you're dealing with. If you're dealing with someone who only sells annuities and insurance products, then that's what they're going to put in the account. If you're dealing with someone like me who has no proprietary investments, we can do everything from individual stocks to my stock portfolios to annuities, for these investments to CDs, anything. Then you have, so it really comes down to what you want to put in them and who you select to work with. And the seventh point is check out the fees and expenses of your investment options. Indeed. I speak with people all the time and I'm checking out their work plan that they're leaving, and the expenses in their work plan are higher, and the fees are higher than their AfroEconomics portfolios that I'm rolling them into. Yes, it is. So look at your work plans and look at what the fees are involved. And then if you find that your expenses within your work plan are outside of the norm where they should be, and amazingly, the bigger the company, the more cost effective the investment should be. They should have, because there's so many participants, you should be getting cheaper investments, but it's not always true. So you have to be very careful. I remember I was working with a church, and I worked with them when they were small, and they got bigger, and they got to, like 100 employees. And when they got to 100 employees, and the assets got to a certain size, they were able to invest, and they had almost no fees. And then the board or someone at the church decided that they wanted to switch them over to an extremely expensive investment that would not, but because of a member of the church was selling those particular investments, they switched them over to something that was costing the participants at least 5% more than if they were making 10% before, they were getting 10%. But when they switched over to this, hurting themselves and the employees a lot more than they were hurting. It wasn't hurting me because the bigger they were getting, the cheaper it was, and the less that I was, actually getting. But this new company comes in, takes everything that I'm doing, a majority company, costing them more. They didn't ask me about it. I tried, and I said, you should have talked to me about it. And it has hurt the participants because of the lack of understanding of the institution about what they were actually doing. And it hurt the employees. But the employees feel like they don't have anything to say because they're just told we're switching to this. But we have to make sure that we bring our voices more into work, because it is because of one person in many situations that says this is wrong, which changes the world. If nobody says this is wrong, this is costing me too much, then the world doesn't change. And I know it's hard being that one who has to say that this is wrong, because a lot of times you're the one that's punished. You're not the one that benefits, but it's about God's plan for your life, because I've gone through it my entire career. You know what I'm saying? But if that's what God's put you here to do, then you have to do it. I've lost a lot of friends, but I sleep well at night because I know that I do everything with good intention. So definitely, let's say, don't lazy because it's automatic. I talked about that. So my last point was check the fees and expenses in the investment options. Stand up for your rights if they're out of control. Don't be lazy just because it's automatic. Don't let them just go. And I haven't looked at that for years, and I don't know what it is, and I don't even know what that is doing at the old job, and I don't even know about it. Don't be lazy. let's make sure we investigate these things. A ninth point is and I talked about this, be careful when you change jobs. In addition to, I was talking about these early withdrawal penalties, but it's also when you change jobs, remember, be careful. Don't just spend your money. Take your future seriously. And a final point for our self-employed people, remember that I do the business workshops on Sundays at 3 o'clock, that as a self-employed person, you have so many investment options. No excuses for not investing and taking advantage of tax deferral benefits. But I must remind you, even though many of us don't have any plan on investing work, because I really would like to be productive as long as God keeps me healthy and make some really good choices with my life, right? But even though we don't plan on stopping, we still need to save, because even if you just pass it on to your legacy, they are starting their life and their career with more than what we had, right? The confidence that will bring to you and to your grandchildren and your children and your grandchildren's children and everybody, that you did the right thing. It just feels so good when I meet clients and they talk about that I can do this because of what my father did, what my grandmother did, what my parents did. It makes a difference. It makes a difference. So if not for nothing, know that you have to be wise about where you're putting your money, and you have to be wise about building your legacy, not because there's a point in your life where you just want to stop working, but because financial independence is important for everyone. Self-reliance, financial independence, second principle of AfroEconomics. First principle, legacy. Develop it. You deserve it. You deserve it. So definitely consider membership. Don't hesitate to email me at any time at jb@jbbryan.com or jb@afroeconomics.com. Email me a screenshot of your phone so that I can see it, and I can send you your complimentary ticket valued at $100, really priceless, for the Black Business Summit. And all members, you are absolutely already covered. Because of you, it is possible. So make sure you go in and register. It will be absolutely free. You all have a great, 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 great day. Thank you for everybody in the webinar for all of your comments. Have a great day.